Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. Welcome to our weekly podcast. Global equities trended mixed over the past week, responding to economic data from major economies. Major Asian markets remain under pressure as data showed Chinese manufacturing PMI remained in the contractionary zone for the third consecutive month, while services PMI, though in the expansionary zone, missed expectations. In US, jobless claims fell from the previous month, while GDP growth for the first quarter of 2023 was revised upwards to 2% from the 1.3% growth recorded in the previous month. Major global equity indices trended mixed, with the MSCI World Index gaining 2.2% over the past week, while the MSCI Emerging Markets, Asia ex-Japan and MSCI China recorded a fall of 0.2% each. In the US, the S&P 500 Index, Nasdaq Composite and Dow Jones Industrial Average rose over 2% each. Back home, Indian equities outperformed global peers, scaling new all-time peaks after a slow start to the week. The Nifty index broke above its previous peak to close at 19,189, up 2.8% for the week, driven by strong foreign investor inflows and positive global cues. Broader markets underperformed Nifty this week, with the Nifty mid-cap and Nifty small-cap indices up 2.8% and 2% respectively. Among sectors, all sectors ended the week in green, with pharma, auto and IT leading the rally with gains of over 3.5%, while utilities and telecom were the worst performers with gains of over 1.2%. Indian fixed income market came under pressure over the past week, with Indian government bond yields rising across the curve driven by muted demand, fresh supply of bonds at the weekly auction, and a sharp surge in US bond yields after upbeat economic and job market data indicated room for further monetary tightening. The 10-year Indian government bond yield rose 4 basis points to close at 7.12%, while the 3-year and 5-year Indian government bond yields rose by 4 basis points and 5 basis points respectively. The INR closed flat against the USD as robust foreign investor inflows negated the impact of rising US bond yields, stronger US dollar, and higher crude oil prices. For the week, the INR closed at 82 per dollar. Brent crude oil rose over 1% to edge closer to the $75 per barrel, driven by strong US economic data and positive upward revisions to USD GDP growth supporting demand outlook. Now coming to other macro updates for the week, the first one was on India's core sector growth, which grew at 4.3% in May 2023, similar to the growth recorded in the previous month. Output expanded for the sectors like up 7.2%, petroleum and refinery products up 2.8%, fertilizer production up 9.7%, steel up 9.2%, and cement at a strong 15.5% growth. However, output contracted for electricity generation, crude oil and natural gas production. The second data was on India's fiscal deficit, which stood at INR 2.1 trillion for the period of April to May of fiscal year 2024. The fiscal deficit stood at 11.8% of the full year fiscal year 2024 target of 17.9 trillion, lower than 12.3% recorded over the same period in fiscal year 2023. Total receipts stood at INR 4.2 trillion or 15.3% of the budgeted target, while overall expenditure stood at INR 6.3 trillion or 13.9% of the budgeted target. Finally, India's gross GST revenue collection for the month of June 2023 stood at INR 1.6 trillion, which was 12% higher than the GST revenue collected in the same month last year. This was the fourth instance the gross GST collection crossed the INR 1.6 trillion mark. At this point, I'll take a pause and thank you as always for listening. If you find this podcast useful, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.